Hi guys, welcome to another video for tutoring. This is going to be part two of types of policies. If you haven't watched the first one, go ahead and go back now. Watch the first one. The first one is about term and whole life. Next, we're going to be going over some, I would say, specialty types of policies, and then we're also going to hit universal life and indexed universal life, all of those fun types of policies. So keep in mind, guys, that we definitely need to be doing our hours. We need to be knocking out those quizzes as we're doing these tutoring videos, because while we're watching these videos, it's not taking up that study time that we need and is required to take our exam. So make sure that you have maybe a tablet, a phone, some kind of device that you're able to log into there next to you so that you can keep on working those hours while you're studying with me, okay? So let me go ahead and share my screen. Perfect. Alrighty. So these I'm going to kind of go through, I would say fairly quickly. You shouldn't get too many questions about them, but I'm going to talk about them just so that we kind of have a good understanding of these terms. Go ahead and move my thing. Alrighty. So the first one that we're going to talk about is called mortgage redemption. Okay, so mortgage redemption, this is more like a provision that you're going to see, and we're going to be going over provisions and options fairly soon. I believe it's like one of the next two chapters. But mortgage redemption provision insures borrowers for an amount equal to their mortgages. Okay, if the borrower or the insured dies, the insurer assumes responsibility for paying the outstanding loan before the insured's creditor. Okay, before giving anything to any other creditor. So it's going to take care of the mortgage first, okay? Now, I'm going to talk about like the types of policies that you may hear about throughout here. So they're going to be kind of spotty. Every time I start with a new type of policy, start with a new set of notes, okay? Because I'm just going to roll through these chapters, trying to make the video as quick as possible. So this one here is a family policy, okay? It will be called a family policy on your test. So a family policy, think about putting the whole family all together on some type of policy, okay? So this is how it's going to work. We're going to say that dad is going to be the breadwinner, right? Dad is going to be the main policy holder. Spouse is going to be wife. Children are obviously children. So how this works is, let's just say dad wants a whole life policy to make sure that he's covered, but he also wants to make sure that his stay-at-home wife and children have coverage as well, right? So this is how a family policy is built. So you have the breadwinner, you have the main policy owner here on the bottom level, okay? Ground floor of this house. They have a whole life policy, just a plain whole life policy, okay? They are going to have level premiums. They are going to have some kind of cash value building in their policy. So this is a generic whole life policy for that dad, for that breadwinner. But he wants to add his spouse, right? He wants to add his wife. So what he does is he puts a rider. So we're going to be talking about riders more in the next couple of chapters, but riders are additions that you place onto your policy that give it benefits that it wouldn't normally have. Okay, so it's called a spouse rider, right? Or a child rider. And if it's spouse and children, then it's a family rider, if I'm not mistaken, which is kind of odd. Like, just pick a name. So spouse rider, this is going to be a term policy that is actually tied kind of on top of the whole life policy. It's temporary protection just to give that spouse the protection that the main policy owner wanted. Same with the children. Okay, the children is going to be a term policy as well. These are riders, additions to the policy, okay? So A base whole life policy will be on the breadwinner with the level term riders for spouse and children. Okay. A family protection or family policy combines whole life and term insurance to cover all of the family members on one single policy. Okay, this will give coverage to every member of the family. These are what it's going to be called. So like I said, it's going to be a spouse rider if it's just the spouse, a child rider if it's just the child, and then as I said, it's going to be a family term rider if it's going to be the spouse and children, okay? Know that for your test because they like to throw those things in there just to see if you know it, okay? Next, we have joint life, okay? Joint life and survivorship life, they cover, let's just say a husband and a wife, right? Let's think of a married couple. This is what joint life and survivorship life is going to cover. Let's just say none of the kids are covered, it's just them. The difference between joint life and survivorship life is the way that they pay out. Okay, so joint life is a single policy that is designed to insure 2 or more lives on one policy. Okay, so let's just say John and Mary, they don't want separate policies, they just get one together, right? That's how that's going to work. So joint life policies can be in the form of term life insurance, and it can also be whole life. Okay, it can be whatever type of insurance you want. The premium for this joint life would be less than the same for 2 separate types of or 2 separate policies. So in order to save money, they're just going to combine both of them on one policy. Okay. Like I said, in real life, we don't see these, but it's out there apparently. Okay. So it's going to be cheaper than getting 2 separate policies. So they get one together, okay? Joint life, right? Joint whole life is going to be the more common one of the two. This functions similarly to an individual whole life policy, but there's 2 exceptions, okay? 1, the premium is going to be based on the joint age of, or the average joint age. Okay, so of John, let's say John's 50 and Mary's 45, they're going to take the median between the two. Okay, so the joint average age is how they're going to come up with the premium. It's not just based off of one person's age, right? And the death benefit is going to be paid upon the first death only for joint life. Okay, joint life, John and Mary have a policy together, one policy together. If John passes away, boom, Mary will receive that death benefit. Okay, she will receive the whole death benefit. With survivorship life, John and Mary, right? They have a policy together, one policy. John passes away, boom, nothing gets paid out to Mary. She continues paying her premiums. She continues doing whatever she's going to do. When Mary passes away, boom, children, beneficiary receives the payment. Okay, so with survivorship, the easiest way to remember is the survivor of the two, right? The beneficiary, the living, is going to receive it. Okay, joint pays upon the first death. John dies, boom, it pays out. Survivorship pays upon the last death, meaning John and Mary both need to pass away in order for it to be paid out. All right. Next, we have juvenile policies. They call these jumping juveniles, okay, which is kind of cute, right? They jump. Juvenile policies, it's just a way to give kids whole life. It really is. So, juvenile life insurance, as the name implies, any life insurance written on the name of a minor. So, any juvenile policy is a policy placed on a minor, right? The common one that we're going to hear about on our test is going to be jumping juvenile. I think you'll only get one question, but when you do get this one question, hopefully you'll get it right because it sticks out. A common juvenile life policy is known as jumping juvenile. This policy is called this because the face amount, the death benefit jumps, not the premium. Okay. One of the, I would say the larger companies that you see this with is Gerber. Okay. It's trash. It's so bad. Don't get it. But this is how they sell it. So they give your child, let's just say $25,000 in the first, or let's go with the numbers that are here on the picture. Here's our death benefit, right? They're giving us 10,000 until we're 21. Once we turn 21, it's going to automatically increase to $50,000 for the rest of the duration of the policy. The premium does remain level, but the death benefit is what is going to be jumping in this juvenile policy. Okay. Why does it do it? It's because when we're children, it's just strictly, coverage for if God forbid something bad were to happen. When we get older, we have bills, we have, responsibilities, we have families, we have different stuff. So they increase that coverage because we obviously need more to cover any cost. Okay. So jumping juvenile, what we need to know is that it's a juvenile policy. It's a policy on a child, on a minor, lower coverage in the beginning, and it jumps 5 times the amount. So let's just say, 10,000, it's going to jump 5 times that and level off for the rest of the duration of the policy. So 10 to 5,000, it'll jump. Okay. Now, with juvenile policies, there is something called a payer rider. Okay. Juvenile policies are for anybody's policy or any child's policy. Okay. Riders, we're going to be going over in one of the next chapters. So I am not going to go into it. Just know that there are protections on juvenile policies, and we will be getting into that in the future. Same with return of premium. We will be going over that when we talk about policy provisions, options, and then possibly riders as well. All right. We're going to talk about indexed whole life. Okay. With indexed policies, there's really only a keyword that you need to remember, or a couple keywords that you need to remember. Okay. It's going to sound just like whole life, right? But it is going to follow the S&P 500, right? It is going to track inflation. It is going to give us a hedge against inflation. Anytime that you hear all of those securities terms, it's talking about the market. It's going to be indexed. It's going to be indexed universal life. It's going to be an indexed whole life policy. Indexed. Okay. Indexed equals market. Okay. So the main feature of indexed whole life, right, or equity indexed whole life, both are the same, right? Insurance of this type of insurance is that the cash value is dependent upon the performance of the equity indexed, such as the S&P 500. For those of you guys who don't know what the S&P 500 is, it's the stock market. Okay, so it follows the stock market. Although there is a guaranteed minimum interest rate, meaning you can't go lower than this minimum interest rate, right? The policy's face amount increases annually to keep pace with inflation as the consumer price index increases, meaning as cost of living increases, okay? Without requiring evidence of insurability. Indexed whole life policies are classified depending on whether the policy owner or the insurer assumes that inflation risk. Okay, just know For your test, you're going to get one question on it. That's it. Like one, maybe two tops. Okay. Just know if you see indexed, if you see equity index, you know that it's talking about the stock market. Okay. And so in our head, we should already know, okay, the rest of the policies didn't say anything about any of that. We need to know that indexed policies ride with the market. They are very, very confusing. They change all over the place. They're a mess, but that's what you're going to have to know so that when you see the question saying which type of whole life policy creates a hedge against inflation, which type of whole life policy keeps up with the S&P 500, right? That's going to automatically scream out to you. It's something index. It's index. It's equity index. It's indexed whole life. Like you're going to know off the top of your head when you see those words. Okay. Because you're not going to see those words in any other type of insurance. All right. Flexible premium policies. This is not for term. Most of this stuff is not going to be term. You'll maybe only get like 2 or 3 questions about term, and it's going to be decreasing and increasing term. Those are like the easiest. Okay. They're going to ask you all kinds of questions about whole life, universal life, because they're confusing. Okay. So flexible premium policies. There are several other types of whole life policies, right? There's all kinds of them. They change them in all kinds of different ways. While they all have some key characteristics, they may also offer unique features based on the policy owner and how they choose to pay these premiums or how the premium is invested. Okay. Flexible premium policies allow the policy owner to pay more or less on their policy. Okay. More or less than the planned premium. Okay. So they're able to put in more into their policy to take out, well, not take out, but pay less than their planned premium. Okay. So one of these types of policies is called adjustable life. Okay. Adjustable life was developed in an effort to provide the policy owner with the best of both worlds, term and permanent coverage. An adjustable life policy can assume the form of either term insurance or permanent insurance. The insured typically determines how much coverage is needed and the affordable amount of premium. The insurer will then determine the appropriate type of insurance to meet this person's needs. As the insured's needs change, the policy can make adjustments as it goes, like as time goes. Typically, the policy owner has the following options. So for adjustable life, all it means is everything is not set in stone. You can change the amount of coverage, you can change the premium, you can higher it, you can lower it, you can skip some things, you can do a lot of different things, okay? 1, this policy owner may choose to increase or decrease the premium or the premium paying period. Okay. They may choose to increase or decrease the face amount, the death benefit, to modify, to adjust to what they need. And then lastly, they can change the period of protection. They can go from term to whole life. They can go from 30 to 40 years. They can go from, 10 to 20 years, whatever. They're able to adjust it. Adjustable life will be easy to see on your test because it's going to talk about adjusting your policy. It'll say that there's changes being made to the premium, to the death benefit, to this, that, and the other, when all of the other policies remain a contract in force, okay? So this one will be easy to point out. The policy owner has the option of converting as well, okay? Convertibility. They're able to convert from term to whole life or vice versa. Next is going to be universal life. Okay. Universal life insurance is also known by the generic name flexible premium adjustable life. The longer the sentence, the worse it is. That's what my upline used to always tell me. The longer the name, the worse it is, man. Universal Life is very popular nowadays. So you're going to get very good at seeing these policies and kind of exposing them in their own kind of ways. But for now, for our test, we just need to know the bare basics. Universal life insurance, please know the name, the generic name of it, flexible premium adjustable life. All this means is that the policy has a target premium, okay? As you can see here, minimum premium, target premium. This policy has a target premium. This is where we should shoot to get to every premium, right? It's like, this is what we want to pay. We can pay less, we can pay more, but this target premium is where they kind of want us to be at, okay? So universal life, right? You're able to kind of make adjustments as the name implies. You're also able to kind of be flexible with your premiums. You can skip premiums if you want to. You could pay extra if you want to. There's a lot of different things that go into it, but keep in mind that if we're constantly paying below the target premium, this is going to affect our policy later on in the future. Okay, there is a price for it. Also, if we're skipping premiums a whole bunch, there's a price for it. Okay, so with universal life, they have the flexibility to increase the amount of premium paid into the policy and later decrease it again. In fact, the policy owner may even skip paying a premium, and the policy owner will not, or the policy will not lapse as long as there is sufficient cash value at the time to cover the monthly deductions for the cost of insurance. Okay, cost of insurance, not what is going into your savings portion, okay? It's a whole thing. We need to just know the basics, okay? If the cash value is too small, if the cash value runs out in your universal life policy, or if you've pulled too many loans from it, this policy will lapse, it will expire, okay? Since the premium can be adjusted, the insurance companies may give the policy owner a choice to pay either one of two types of premiums. The first is called a minimum premium. This is the amount that's needed to keep the policy in force long range, okay, for that current year. Paying the minimum premium will make the policy perform as an annual renewable term product. It's just the insurance, right? Then there's the target premium. Target premium is the recommended amount that should be paid on a policy in order to cover the cost of insurance protection and keep the policy in force throughout its lifetime. Okay, meaning it will the perfect amount to go towards the cost of insurance and towards your cash value. Okay, because remember, with whole life, with universal, we're paying two separate things. If an insured skips a premium payment on a universal life policy, the missing payment may be deducted from the policy owner's cash value, and the policy will not lapse unless there is no more cash value in there. Okay, we are going to be talking about a provision, I believe it is, called the automatic payment or automatic loan, premium loan option, something like that. It's an option, that's right. When we talk about another chapter, this is going to apply to policies like this. It allows the company to automatically go into your cash value and take that deduction if you do not pay your policy. And so you see a lot of these policies lapse because over time they become very expensive and people can't keep up with it. But regardless, they are able to do this right here because of that automatic premium loan option, I believe is what it's called. But we're going to be going over that in another chapter. All right. Perfect. Okay. So with universal life policies, they do allow you to withdraw from your savings, from your cash value, okay? So universal life policies, right? They allow partial withdrawal or partial surrender of the policy's cash value. However, there may be a charge for each withdrawal, and there usually is limits as to how much you can take out, and then also they may charge you interest on it as well. Okay. During the withdrawal, the interest earned, right? Whatever we have not paid taxes on will be subject to taxation depending on the plan. We need to know taxation for annuities, for universal life, and for whole life, okay? So whole life policies, everything is tax deferred, meaning you only pay taxes when it comes out on the interest earned. Okay, so on whatever amount of money had not already been pre-taxed, or on the, yes, like on the amount of money that has not already been paid taxes on, right? So anything that grows in the policy, we're like key thing is that if it hasn't been paid taxes on, you have to pay taxes at some point. Sooner or later, it's going to have to get paid taxes on. So depending on this plan, it would depend on the taxation on when you were going to pay taxation, okay? So the death benefit will be reduced by the amount of this partial surrender, okay? There's always going to be something. If you pull out of these accounts, they're going to take it from somewhere. They're either going to make you pay it back or they're going to take it from your death benefit. It's one or the other, okay? If you don't pay it back, they're still going to take it from your death benefit. So you're taking money out of your own money that they're still going to take back. So that's kind of like a disadvantage of these kinds of policies. Note that, however, that partial surrender from the universal life policy is not the same as a policy loan. Okay, so if you pull out of it, right, they're going to replace it with part of your death benefit, but you're not necessarily going to pay interest or pay it back the way that you would with whole life, okay? For death benefit options, this is the one that I was telling you about. With universal life, you're able to have two options. There's option A and there's option B. Code word for option B is both. Okay, universal life policies offer one of two death benefit options to this policy owner. Option A is the level death benefit option. Okay, what this means is you are only going to receive what your death benefit was. Okay, up until a certain point. With option B, this is the increasing death benefit option, meaning your death benefit is going to be increased by the amount that you are saving in your cash value. You are going to learn lots about these, okay? It doesn't make sense the way that they paint it, but it's just how these policies work, okay? So under option A, the level death benefit option. Option B, I kind of get why people would get it, right? I'm like, okay, it makes sense. But option A just does not make sense to me. Option A. Under option A, the level death benefit option, the death benefit remains level while the cash value gradually increases, thereby lowering the pure insurance with the insurer in the later years. Notice that the pure insurance is actually decreasing as time passes, lowering the expenses and allowing for greater cash value in the older years. The reason that the illustration shows an increase in the death benefit at a later point in time is so that the policy will comply with the statutory definition of life insurance. Meaning, let's just say here, okay? Here's our policy. At this point, right, it reaches, notice our death benefit is $100,000. It's $100,000 all the way across until here. Then as our cash value is increasing, it starts increasing with it as well. But as you can see here, there's very little actual insurance protection. The insurance protection is the blue color here. Our cash value, our savings, is the red color here. Okay? So what they're talking about is as our cash value grows, right? As it increases, as you can see, there's less and less and less blue all the way through here. See how this is like less and less and less until there's like almost no insurance. It's all savings. That's what it's talking about. So with option A, you will only ever receive the amount of the death benefit or however much our cash value then grows to. Okay? We are not getting both. We're getting one. Okay? At any point during all of this, we are only ever going to receive that 100,000. Now, when it gets a little bit into the older years, right? The only reason why they keep this IRS corridor is what it's called. It keeps a little tiny bit of life insurance protection here is so that we can retain the tax benefits, right? Of our savings being this big. Okay, because if the life insurance is no longer there, if the coverage is no longer there and it's just a savings, we would owe large amounts of taxes on it. Okay, because life insurance has tax benefits. Okay, so just know for option A, it has the IRS corridor. Okay. The IRS corridor is so that the policy will comply with statutory definition of life insurance that was established by the IRS and applies to all life insurance contracts issued after some date. You don't need to know the date. You just need to know that option A has that corridor. According to this definition, there must be a specified corridor or gap maintained between the cash value and the death benefit in a life insurance policy. The percentages that apply to this corridor are established in a table in your policy. Okay, so it'll give them all of that information there. Okay. If the corridor is not maintained, the policy is no longer defined as a life insurance policy for tax purposes and consequently loses most of the tax advantages that have been associated with this life insurance policy, like deferred taxes. Okay. So just know option A has that tax corridor and you only get one of the benefits. Option B. Okay. Option B is both. Your life insurance is going to remain the same. You are always going to have the same amount of pure protection. Your cash value is a bonus. Okay. It pushes that protection up every time it grows. Option B, which is also called the increasing death benefit option, the death benefit includes the annual insurance and the cash value so that the death benefit gradually increases each year by the amount that the cash value increases. Okay? At any point in time, the total death benefit will always be equal to the face amount of the policy plus the current amount of cash value. Since the pure insurance with the insurer remains level for life, the expenses of this option are much greater than option A. Okay. In these types of policies, on the actual policy itself, it will say option A or B. And when you're licensed and you're replacing one of these policies, you need to know that. You need to look for that because it's easy to give the client the wrong information, right? If we don't know which type of policy we're handling or which rider it has, okay? So this causes the cash value to be lower in the older years, but all else is becoming equal, okay? All right. Perfect. We already talked about indexed policies, whether it's indexed whole life or indexed universal life. The universal life option is going to work pretty much the same as normal universal life. The difference is how you're going to be able to see it on the test. So indexed universal life is a universal life policy with an equity index as the investment feature, meaning it is going to follow the S&P 500. It is going to follow inflation. It is going to, you need a securities license, right? There's a lot of different things that go into it, but you're going to know because it's going to talk about equity. You're going to see the word index. You're going to see S&P 500. You're going to see different words that scream securities. You're going to know that it's indexed. Okay. So those are the keywords that we're looking for. Has the same characteristics as variable universal life, meaning it has flexible premiums, an adjustable death benefit, and the policy owner decides where the cash value will be invested. The primary difference being that the investment feature under a variable universal whole life policy. Oh, I'm sorry. The main difference is going to be that investment feature, the fact that it is going to be tied to the market and not just be on its own through the insurance, okay, through whatever interest rate the insurance gives them. It will actually follow the market, therefore it can go up, it can go down, and it will have a minimum, okay? Keep in mind that cash value is dependent on the performance of an equity index, meaning the stock market. Okay. All right. These ones as well. They work the same. So survivorship, universal life, you shouldn't get any questions about specifically universal life. They're just going to talk about survivorship. So you need to understand that survivorship, right? John and Mary, John dies, boom, Mary dies, boom, beneficiary gets the coverage. With survivorship, it pays upon the last death. With joint, it pays upon the first death. That's all you really need to know for these ones. Just know that survivorship in any kind of policy, whether it's term, whether it's whole life, whether it's universal life, they pay for survivorship when both of the insureds have passed away. All right. Okay. Next, we have variable products. Okay. Variable products means that you need extra licenses. Okay. You need your securities license. So we have fixed, right? Fixed life insurance or annuities are contracts that offer guaranteed minimum or fixed interest rates that are stated in the contract, meaning you only need your life license to do those. Okay. Variable life insurance products and annuities, because you can do both, right? That's what our license does. Variable life insurance policies or annuities are contracts in which the cash values accumulate based upon a specific portfolio of stocks without guarantees on performance. Okay. Variable annuities keep pace with inflation and are determined by the value of the securities backing it. Just know that with anything variable, whether it's life insurance, variable life insurance products, or variable annuities, you need a securities license. Okay. First one is going to be variable life. Variable life insurance, sometimes referred to as variable whole life insurance, because it's pretty much the same. The thing that makes it variable is the fact that the interest rate is following the market instead of being the guaranteed interest rate that the insurance company gives you. Okay, so anytime you see variable, you know that it's following the market. Okay, same thing as indexed. Okay, those are screaming market. Market, 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 securities, securities, securities. Okay. This is a level fixed premium. The investment is based on the stock market, right? It follows a certain portfolio. Like traditional forms of life insurance, these policies have fixed premiums and are guaranteed minimum death benefits, okay? So it does have guaranteed minimum death benefits. The cash value of the policy, however, is not guaranteed, okay? Anytime you see the word variable, it is not guaranteed, okay? There might be minimums, but it's not guaranteed. It fluctuates with the performance of the portfolio that it's following, okay? The policy owner bears the investment risk in a variable contract, okay? In regular life insurance and annuities, the insurance company bears that risk. In variable, the policy owner, right? The person paying those premiums, the policy owner, the annuity owner bears that risk because they are choosing to allow their policy to follow the market. Okay, we will get more into that when we talk about annuities and it'll make more sense. Okay. All right. Now, we're going to talk about general and separate accounts. I'm sure we will be talking about that more later on. In annuities, we definitely will be talking about it. But in general, insurance policies, right? Any kind of insurance policy that it's not variable, right? The cash value, right? The whole life, the universal life, the cash value is actually held in a general account, meaning that these are funds that the insurance company is bearing the risk for. Okay. In variable products, right? The funds are kept in a separate account, because it's following a separate, right? There's no promise. There's no guarantee on these funds. It needs to follow its own market, its own portfolio that it's taking care of. So anytime you see variable, all of the assets must be held in a separate account, which invests in stocks, bonds, and other security investment options. Okay. Any insurance company that is issuing variable contracts must establish one or more separate accounts in order for these products to be offered. Okay. Please know that. In order for an insurance company to offer variable products, they must have a separate account or various separate accounts. Alrighty. We have variable universal life, right? Variable universal life insurance is the type of insurance that combines many features of whole life with a flexible premium and a with flexible premium universal life. Okay. The investment component of variable life, making it a securities version of the universal life insurance. So like I said, it works exactly like universal life, which we just spoke about. However, it is going to have investments in different areas. Not different areas, but it's going to be linked to the S&P 500. It's going to be linked to some kind of portfolio. It is directly investing into the stock market. Okay. All right. So when it comes to variable products and with licenses, this is what we need to know. Okay. So there are a couple of different places that regulate variable products. It's going to be the SEC, the Securities Exchange Commission. It is going to be FINRA, and your state. So the state also kind of watches it, but mostly these two here. Variable life insurance products are duly regulated by the state and by the federal government. Due to the element of risk, right, investment risk, the federal government has declared that variable contracts are securities, okay, and thus are regulated by the Securities and Exchange Commission and the Financial Industry Regulatory Authority, FINRA, okay. Variable life insurance is also regulated by the insurance department as an insurance product as well. Any agents that are selling variable products, right? They must be registered with FINRA. Must be registered with FINRA, okay? They must be licensed by the state to sell life insurance and receive their securities license, okay? There is a trick question on your test talking about the SEC. The SEC just observes. You do not need to be registered with the SEC. You only need to be registered with FINRA. Okay? And then we have the policies compared. Please go back and look at these. That way we can really understand, right? You might need to go over these multiple times. I suggest reading the chapters because they can be quite confusing. Okay? Next, we're going to have individual versus group life insurance. I'm just going to kind of go over this quickly. These ones are fairly obvious. Individual life insurance is written on one single life, right? And the rate of coverage is based off of this one person's life. Okay, the underwriting is done off of the one person. This is typical life insurance. Group life insurance, right? Like what people get with their work. This is a master policy issued on a sponsoring organization. Okay, it covers the lives of more than one individual or member of that group. Individuals covered by group life insurance do not receive a policy. They receive a certificate of insurance. Okay, know that for your test. The amount of coverage on the certificate holders must be determined according to the non-discriminatory rules, meaning everybody receives the same amount of coverage. The rate and coverage are based upon the group underwriting with all individuals covered for the same amount and rate, and the cost of coverage paid by the employer in excess of $50,000 is taxed to the employee. Basically, everybody pays the same. Everybody gets the same amount of coverage. It's all based off of that master policy. Keep in mind that group life insurance, you only receive a certificate. You do not get your own policy. Okay. And then lastly, the other characteristics of these group life insurance policies, the group must exist for a reason other than purchasing group life insurance. So there was one part on my test twice when I took it, saying if it's a group of people, right? I think it was a group of skydivers get together and they try to get a group life insurance policy to get lesser cover or less expensive premiums, right? That was the reason why they were getting that group life insurance policy. Can they do that? No. The group life insurance policy is not able to be formed solely to save money for this group, okay? So it must exist for a reason other than purchasing that group life insurance. It has to be offered. And then individual members are covered under the group master policy. They must have the right to convert their coverage to an individual policy without evidence of insurability should they leave the group, such as being fired, terminated, or retiring. Okay. So that's it for this chapter. I know that was a doozy, guys. That was a long one. So everybody, I hope that you all, catch up on these last two chapters. Types of policies was really important, but the next couple of chapters that we're going to go over are going to be big. They're going to be packed. So we want to make sure that we are studying, right? We're getting ready for our for our exam, and that we're taking quizzes on types of policies often. Okay, so I hope you guys all have a great evening, great day whenever you're watching this, and I'll see you in the next chapter.